I'd have to say that it was really a combination of what was going on in the industry plus some good luck on our part, kind of happenstance. I think if you go back and look at the industry back at that time, it was beginning to evolve in ways that it has very much continued to evolve. So if you go back in sort of 2015, 2016 timeframe, and what you were seeing was, number one, a pretty broad acceptance that private markets genuinely outperform public markets most of the time in most places. And the data was just coming in then. It was much less of a debate than it had been early on. And that was driving demand. You had people saying, well, why shouldn't we be able to access private markets? You know, these endowments can do it, and these pension funds and these big family offices, but why shouldn't everybody else be able to access these things that are really driving such great returns? So you had that. You had a structural change in the funding of private markets. So private markets forever, the majority of the money into it had come from defined benefit pension funds. And yet defined benefit pension funds were kind of a dying animal. There hadn't been any defined benefit pension funds created in any bulk in the US since the 1980s. And so you had this shift to defined contribution and to wealth management as ways of focusing on people's retirement savings, and yet those areas had no ability to go into private markets because of the lack of liquidity, lack of data, lack of information, and all that. And I think we felt like that was going to change. I'd say the third thing was the growth of private markets was pretty extraordinary. I mean, 20 years ago, there was under $1 trillion in private markets worldwide. That's everything, private credit, venture, buyouts, the whole world was less than $1 trillion. And it was heading, you know, by 10 years ago, it was something probably $7 or $8 trillion, heading to where it is today of 13 trillion. And just the scale and the complexity of the private markets was so large that you could look at these things and say portfolio construction could be done in ways that would fit a more of an evergreen type of construct. And that then led to the development of the secondary market, the development of the private credit market. These are all things that have different duration profiles than your typical venture or buyout type fund duration profile. And the mixture of those duration profiles allowed you to be able to offer liquidity, which was the key to the evergreen thing. And then I think the final thing I'd say was just back to the points that we've talked about before of tech and tools. We had so much data, and there was so much analysis that was necessary in order to create these evergreen vehicles. They're fundamentally different animals than a drawdown fund. Don't believe it if someone who manages drawdown funds comes to you and say, hey, I can do these too. They can't unless they have the data and the tools to be able to manage these very diverse, very complicated portfolios. Finally, on the happenstance, we had a client that came to us and said, you should do this, and we'd like to support you in doing this because you've got the deal flow. You've got the ability to put together these transactional-oriented portfolios that don't have the 1.5 and 20 drag of an underlying fund in them. You should do that. The very long answer to a very short question, but it was a confluence of different things.